So that is what I think the market is not focusing on. They're talking about tokenizing real world assets like houses and whatever. Great. The reality is digital ID is probably the biggest use case of all outside of money. In an AI world, we've got massive applications to come out of a number of different areas, and one of them is the area you're working on as well. Just anything that gets transferred on the internet can be done in this way.
Hey guys, welcome to Everyday Finance. The system is running out of space and time is running out. Lower interest rates and increased money printing are the only ways to avoid the trillions of dollars in debt that are due. Markets, politicians, and even insiders are aware of it today. Everything could be redefined in the upcoming year, with repercussions felt by all asset classes worldwide. The CEO of Real Vision, Raoul Pal, has issued that warning. Although the path ahead is fraught with danger, he thinks the current business cycle will last until late 2026. Central banks must inject money or risk collapsing as $9 trillion in debt is about to roll over. Pal refers to this process as the everything code, in which policymakers are caught in a never-ending loop of devaluation by debt, productivity, and demographics. Cryptocurrency and other limited digital assets might be the most valuable in that scenario. Crypto might be the main winner in a world where liquidity is a problem as traditional markets suffer from depreciated currency. Pal cautions that missing this cycle could be the most expensive error of your life, so pay attention.
My story is like 35 years of financial markets. I was grew up in the UK. I was at Goldman Sachs, where I started and ran the hedge fund sales business in equities and derivatives. I then went and ran a global macro hedge fund for GLG Partners, who was the largest hedge fund firm in Europe, back in the early 2000s. Then opted out of the rat race, moved to the Mediterranean coast of Spain to get out that miserable English weather, and started writing macro research called Global Macro Investor, which I still write 20 years later, which is kind of a high-end research service for the world's biggest hedge funds, family offices, sovereign wealth funds, that kind of thing. As part of that journey, where I kind of analyzed the global economy and global economic trends and global markets, I managed to get the financial crisis right and then the European debt crisis right. And it was over that period that I realized how screwed the entire economy was because of how much debt there was out there, and that nobody actually owned anything in the financial system, whether it was a bank account, because in Cyprus they took all your money, or whether it was Lehman Brothers, where nobody owned the collateral. And I thought, I should do something about this. And that ended up in a long journey of me trying to start a bank anywhere in the world's safest bank. It was going to be not fractional reserve banking. We ended up getting the chairman of the FDIC to be our chairman. We were buying a bank in Texas, and we went to the Dallas Fed, and they said, "This is a brilliant idea. We'll never give you a license." I'm like, "Why is that?" They're like, "Because you'll take all the deposits." So I wrote about it in GMI as like, wow, this was shocking because it was true. And somebody said, this is 2012. Somebody said, well, you need to look at Bitcoin. So that started my crypto journey, where I realized that was the answer. I then also, as part of that whole period, people would come up to me and said, why didn't we know what was going on? Friends of my parents, friends of friends, everyone lost money. Half my friends in Spain went bankrupt. And I'm like, yeah, we're not doing a good job of really democratizing the information that's held within the hands of a few. So we started Real Vision, which was the world's first kind of long form media platform. That's how we started, without a full kind of platform for investors in a number of different ways. So that's been that journey. Also, I've got an asset management firm called Exponential Age Asset Management that invests in crypto hedge funds to try and capture the trend of what we're at $4 trillion market cap today in crypto. I think it goes 100 trillion. So that's a way of capturing that mega trend. And in addition to that, I'm also on the board of the SUI Foundation. It's an inverse model to anything we've seen before. So retail drove the thing from start, which was fascinating. And then the financial system, I've always said, and I've been saying for a decade, we can front run the institutions. And we had basically 10 years to front run them. Now they come. Regulations change. They're coming. and they're coming in the financial sector first. So stable coins, it's a way of the US broadening its reach of the dollar, but it's also a way of financing the debt, which is a huge problem. It still remains the biggest economic problem to date. And then on top of it, blockchain rails are just more efficient for settlement, instantaneous ownership. This decentralized ledger is extremely useful for the financial system. Things like NFTs work really well for things like derivatives, because those are just contracts and we can turn them into smart contracts. So that's the financial system, and that is now igniting and starting its journey. So the next 5-10 years will be all of that moving to blockchain rails. But there's vast parts of the economic engine that is based on the internet, that really the blockchain, if you think of the blockchain as a different way of organizing the internet itself. So there's value that gets transacted. There are contracts from everything from tickets to whatever it may be that exist that are more efficient on blockchain rails. You create a world where not only do you read and write, which is the internet, but you own it as well. So you own your own data, and you have the transparency of what blockchain does. So that is what I think the market is not focusing on. They're talking about tokenizing real world assets like houses and whatever. Great. The reality is digital ID is probably the biggest use case of all outside of money. In an AI world, we've got massive applications to come out of a number of different areas, and one of them is the area you're working on as well. Just anything that gets transferred on the internet can be done in this way. As a model for me is broken on many, many levels. One, it's purely extractive of our attention. And yes, in exchange we get free services. Okay. But the power with which that attention is concentrated in the hands of a few corporations is simply staggering. You know, how much information Google has on us all is beyond anybody's comprehension. People, are fighting like governments that we shouldn't give them our information. I'm like, you have no idea. My Google Nest knows which room I'm in at any stage, when I'm on holiday, what time I sleep. Your Roomba tells you exactly the dimensions of your house. I mean, it is unbelievable how much information they have. And how they monetize that is through advertising.
According to Raoul Pal, the traditional approach to investing is no longer effective. Once a pillar of stability, diversification is ineffective in a world where all assets fluctuate in tandem with central bank liquidity. Investors today want double-digit returns simply to maintain their purchasing power, because fiat currencies are silently losing about 8% of their value annually. On top of inflation, Pal supports hyperconcentration, or allocating capital to assets that have the potential to outperform the system. For this reason, the mechanics are laid out in his everything code: declining populations, stagnate output, and governments becoming more and more dependent on debt. Global markets are linked to central bank balance sheets in an unending cycle of monetary expansion as a result of the financing of that debt through the production of liquidity. According to Pal, the same forces that govern the system have rewritten the rules, not just altered them. Let's go back to his conversation now.
I'm still actually not sure about the listening thing, because I noticed things that, we all notice it. So there's something going on, and, generally you don't mind, but we're going to move into a world where AI is going to capture a lot of the value chain of human work. So where is our role in this? We need to get paid for our attention. And so my view is that somewhere between your digital ID and what happens with advertising, that you have to share the revenue directly with the people. Now, YouTube do it a little bit if you've got your own YouTube channel. Twitter does it if you're a super node on the network and you're garnering attention. But there are many other ways of which we can earn a living ourselves for our attention. That's kind of interesting. I know we saw it with Brave Browser with the basic attention token. Interesting start. So that's one part of the advertising industry. Well, we'll talk about that part, and then we'll talk about the murky world of plumbing as well. Because what they're paying for is a success rate that is low. So what you've got, so conversion rate is very low from an online ad. Now, if you have high quality information about me and you
Mhm.
serve me ads directly, of which are valuable to me, your conversion rate is going to go through the roof.
Mhm.
So in which case you're going to pay more for that because it's higher quality
true.
lead, but
Yeah.
you'll probably still save money as a brand because
Mhm.
you're better targeting. And so therefore, will I be sharing a fraction of $5 or share a fraction of $1,000? I don't know.
Yeah.
But if you think about how much time we spent online in a year,
Mm.
does that add up to a few $1,000s? Or, if you're an intense user of the internet, could you make $10,000 a year? Great. It's not a living, but it's a way. It's
Yeah,
kind of
that's
like
true.
if you think about adding solar back to the grid.
Mm.
You're participating in a network of which you get economic value, which is they buy the excess energy from you.
Yeah.
Right. That's how I think about it. I don't think of it as like, oh, the advertisers are going to make us rich. No, it's not going to happen.
Yeah, we
But
quit. Yeah.
baseline income or cash flow. Okay, that's interesting because we are, in the end, I think we're moving towards more network states, and
Yeah.
therefore nodes in the network who add value need to get economic incentivization, and that can be via tokens, which I think is
Mhm.
the organizing principle for larger networks. I think that works well.
Yeah.
Think about that for a second. If you go to an advertiser who goes to X,
Yeah.
right, there's probably now, I don't know the numbers and nobody will admit it, but let's assume it's like 30%, 40% agents now,
Yeah.
or bots in one way, shape, or form.
I would say so. Yeah.
Then you're, as an advertiser, your CPMs just keep diminishing, and we've seen that over time because the quality of who you're advertising to keeps diminishing. We saw the same with a huge rise of let's say India on the internet.
Mhm.
So you might target a person on the internet, but if they're from India, actually their propensity to spend because of the average income is lower, but they're probably going to be in the next few years the largest English speaking part of the internet.
Yeah.
So it becomes an issue for brands. And having gone through this myself,
Mhm.
the other thing that happens, when we get to the murky world of advertising, is you get click farmed to death,
Yeah.
and brands get abused. I mean, that's a real issue. So I'm not looking at it from, hey, brands are abusing us as people. I'm thinking
Mhm.
everybody's getting abused in this system, and a more direct peer-to-peer way of doing it actually solves a lot of problems. I've never really talked about, or not for a long time, is when Real Vision started, Google came to us and said, look, you guys are really interesting. I'm going to work with you.
Mhm.
We're going to help you with ads. Give us a budget. At the time, it was a huge budget for us. We barely launched. It was like,
Yeah.
give us $250,000. It's going to take you 3 months, and we'll prove to you how effective it can be. We went through the entire $250,000, didn't move the needle at all. And when we broke down where the traffic was coming from, look at all these views you're getting on your ads, etc.
Mhm.
They were all farms. And this was coming direct from Google themselves. And I'm like, this is exploitive of everybody. You said something interesting that's just triggered a thought in my head. You said like magazine, right? Now imagine if you had a high-end magazine like Wallpaper or whatever it is, right?
Yeah.
And that magazine gave you an NFT
Mhm.
when you subscribe. And now they can kind of look at your social graph and figure out who you are. You can give some
Yeah.
basic details. If you give some basic details, maybe in a zero knowledge proof format,
Mhm.
embedded with NFT, then maybe the magazine can share the advertising revenue because the advertising revenues go up because you've got more information about your audience, and they then accrues to your NFT. So you're now becoming empowered as a node in the network because they're saying, we value your attention for the advertisers. We will
Mhm.
share some of that. Maybe the subscription cost has to go up a little bit to counterbalance. So there's going to be
Yeah.
a weight. And now you've got readers who are part of the economic engine of what the success of that is. Okay, now you've got something interesting. That's what Web3 enables. It enables that side of the equation. When you own your attention in some respects, or share
Yeah.
your attention, or permission your attention,
Mhm.
now everybody can win. The
Yeah.
newspaper or whatever, or YouTube or whatever it is can win. You win. The advertisers win. I mean, there's nothing wrong with that. I think everybody would be
Right.
happy if it happened. It's just crowdsourcing factoring. Factoring has been how the world has worked because of cash needs, instant cash needs versus payment times, because everyone manages that, and there's a margin to be made in the middle, which is interest for lending money. Now, that was always a centralized system, and now you can crowdsource factoring at scale. So,
Yeah.
Great. Yeah, invoice financing. Fantastic.
That's
I mean, ads are a massive commodity that are traded online in vast scale. People have no understanding.
unbelievable. Yeah.
The mirror financial system that is going on, much also like things like shipping are as well. Freight contracts, all the same, and they all require funding, and they all have the same issues. But the velocity and speed and size of the advertising industry is something people don't understand. The fact that high frequency traded firms like Virtue and others are involved in this market because it's very murky, it's not regulated.
Yeah.
The spreads are egregious. There's a lot of arbitrage. There's a lot of manipulation that goes on. And you and I talked before about this. It's like a friend of mine used to run The Guardian, and the spread between what Unilever paid for an ad and what The Guardian received, 70 to 80% was lost.
Yeah.
Somewhere in the middle. And they're like, this is insane.
Yeah.
And that is a huge problem for the system itself. Yes, there is the reason you lose a lot is because those people are providing liquidity, but we don't need centralized liquidity. We can use decentralized liquidity, and then we can all participate. And what we'll see is the spreads narrow, the system becomes more efficient, everybody participates and gets yield out of it.
The limitations of the system are approaching. The equation breaks down when interest rates continue to rise faster than economic growth, since productivity alone cannot pay off the debt. Only monetization remains as a viable option. Just to cover the interest, governments create money, which feeds what Raoul Pal refers to as ultra-liquidity waves, strong 4-year cycles that have guided all of the major markets since 2008, all boat stocks. Commodities, Bitcoin moving in time with central bank liquidity, are lifted and sunk by these waves. The subsequent peak was postponed until late 2026 by the last significant refinance in 2021 to 2022, which bought time but increased the pressure in the end. With $9 trillion in debt due in less than a year, it now appears that another liquidity flood is unavoidable. History demonstrates that limited assets increase when money floods the system. This time, cryptocurrency might be at the forefront, not just as a transaction, but also as a means of surviving in a world where the value of fiat money is declining. The only question that remains is timing. Will you be keeping assets that depreciate against the tide, or will you be prepared before the next wave breaks?